So sorry I can't be with you today live and have had to pre-record this, but I'm heading down to Heathrow to pick up my son, Angus, who is returning from a year in Australia. So very exciting. So talking about exciting things, I want to share with you some top tax tips. You have to say that very carefully. These broadly fall into three main areas. Firstly, how can you improve that all-important cash flow, something dear to most of our hearts? Then we'll look at some planning opportunities, particularly whilst asset values and share values are depressed. And last, but by no means least, getting ready for what comes next, being the inevitable tax rises. So let's start with looking at ways to improve your business cash flow position. Starting with really the job retention scheme, furloughing, the new word that was being so widely talked about over the past few months. This has been an essential lifeline for many businesses, generous, quickly introduced by the government and extended through the end of October this year. There are a couple of points I wanted to flag around the job retention scheme. Firstly, are you confident that you have computed the claims correctly? As this is going to be an area that HMRC will look at keenly over the coming years, particularly for those employers who have furloughed a significant number of employees. Don't forget that the record keeping requirement around the scheme is 5 years rather than the normal 3 years, which would suggest that HMRC will have plenty of time to investigate claims in the future. The second point is on the ability to bring employees who have already been furloughed, and the cut-off date, remember for this, was the 10th of June, by the way, on a flexible basis, so part-time working and part furloughed. Now, many clients are looking at how best to bring furloughed workers back using this new flexible arrangement, but at the same time trying to be fair to the wider workforce, not forgetting those hard-working employees who have continued to work throughout on 100% pay and probably been asked to deliver a very full workload in the process. So invest some time in looking at the different options you have on this front, as I'm sure it will be time well invested. The next point is around corporation tax payments or repayments. If your business has suffered as a result of COVID-19, be it through reduced profitability or actually making trading losses, then you should carefully consider whether you could mitigate your corporation tax position by crystallizing any trading losses at the earliest possible opportunity. It may be that by either extending or shortening your existing accounting period, this could reduce an upcoming corporation tax bill, or better still, actually generate a tax refund for HMRC. It's for example, I think if you normally draw up your accounts to say 31 December, but trading has been significantly depressed for April, May and June this year, which I think will apply to many of us in this room, it may be appropriate to switch your accounting reference date to say 30 June 2020. And that's either by having an 18-month long period rather than to 31 December, or run a short 6-month period, so that the loss-making period either reduces the tax that you would have paid for the year to December 19, or generate a trading loss that can be carried back and give rise to a tax refund. There are clearly other important commercial considerations around changing your accounting reference date, but if you haven't looked at this as a possibility, then you should at least have it on the agenda to discuss. Linked nicely to the above is making sure that you're maximising the ability to claim research and development tax credits. Our experience from working with lots of clients in this area is that most are surprised by how wide the definition of R&D extends. The simple test is that if you try within your business to either change or improve a product or a process, the chances are that you're undertaking some R&D. This delivers some significant tax benefits, and it may be that by changing your accounting reference date so as to crystallise losses as soon as possible, as discussed in the above point, the timing of making an R&D claim should also be factored into this. The next point, paying HMRC. They're often a very big creditor, if not your biggest creditor. Many of you will have enjoyed the VAT holiday, but where do you stand in paying the other ongoing taxes, be that corporation tax, pay-as-you-earn, VAT, etc.? If your cash flow forecasting is highlighting some pinch points with regard to cash flow, bank covenants over the next 12 months, then having an early discussion with HMRC on a possible time to pay arrangement is seriously worth considering. Our experience is that provided you have some sensible cash flow forecasts and go to HMRC with a suggested payment plan, they are currently very amenable to granting time to pay arrangements. And certainly don't just bury your head in the sand and miss the payment deadline, as otherwise you'll be facing HMRC debt management team who can be far less helpful. I'm putting that politely. Before I forget, there is an automatic deferral for individuals of the 31 July 2020 self-assessment payments on account until the 31st of January 2021. So there's no need to elect or claim the deferral, and there's no interest or penalties. Now, HMRC's guidance suggests that individuals should pay the tax on 31 July if they can afford to do so, but it'd be fair to say that most of our clients are looking to take advantage of this 6-month interest-free deferral, so keep their powder dry. And just to dispel the misnomer that this only applies to self-assessment payments on trading partnership profit, no, it covers any self-assessment income tax payment that may arise from things such as bank interest, rental income, dividends, partnership profits, etc. So in this category, the last thing, a nice thing to do for those hard-working employees who have gone the extra mile over the past 3 or 4 months. What about electric cars? We've read a lot about that in the press. You get 100% corporation tax deduction. That's a pretty good start for new vehicles. And this relief has been extended right through now to April 2021, coupled with very, very low benefit in kind charges on the employee. So rather than paying bonuses, etc., which could be difficult from a cash flow point of view at this point in time, what about that new electric car? Food for thought. So moving on and look at some planning opportunities, particularly whilst asset and share values are depressed or may be depressed. Have you ever looked at introducing a share incentive scheme for your key employees to help retain and incentivize these individuals who may well play a key role in the next phase of growth recovery of your business? If your business has suffered as a result of COVID-19, then the cost of issuing shares or options to your employees could be lower at present. And it may be the perfect accolade for those employees rather than promising a large bonus when things get better. We've all heard that before, I'm sure. Certain schemes can be very flexible and tax efficient and tailored to your business needs, such as EMI and growth shares. So the message here is that it's probably a good time to revisit this, even if it was something you've put on the back burner. The next point is around de-risking assets. Are your crown jewels sitting somewhere in your business? And have you been worried about these over the past few months? This could be the trading premises that you own, surplus cash funds that you've built up. Generally, these types of assets within the company can have a negative impact on the availability of certain generous tax relief, such as business property relief for inheritance tax purposes and business asset disposal relief, which actually is the replacement for entrepreneurs relief, the old entrepreneurs relief. More importantly, if these assets are within your corporate structure, they may also be exposed to trading risk. The key action here is to look at whether you could restructure things in such a way to still retain the valuable tax relief, but to give you some commercial separation from the trade and the trading risk that comes with this. Linked to the above, should you or the key shareholders in your business revisit any succession and IHT planning at this time while share values are likely to be depressed? Which may involve transferring shares and the use of trusts and that sort of thing. So we currently enjoy a really benign regime on this front, and this is certainly not going to get any better anytime soon. Which brings me nicely onto my final point, you'll be pleased to know. Getting ready for what comes next, tax rises or heaven forbid, new taxes. Ooh. Firstly, is your business structured in such a way so as to take advantage of the existing reliefs, which I referred to some of these above, including business property relief and the replacement for entrepreneurs relief, business asset disposal relief. That's a bit of a mouthful, but BADR, as I'm sure it'll get referred to. And it's not just about securing those existing reliefs. What if capital gains tax rates for individuals went up from 20% to say 30%? Not inconceivable. Should you look to trigger a capital gain now? Do you have cash and reserves in your business? Back to the days of advancing income to secure the known tax rates. I know it's not that palatable, but 38.1%, that's the rate you pay on dividends currently for additional rate taxpayers. Should you declare any dividends in the current tax year to 5 April 2021, will that be good enough to secure the existing rate before almost certainly income tax rates go up? It'd be fair to say that we are unlikely to see any tax rises being announced by the Chancellor in July. This is more about a spending review and how it can help kickstart the economy. But don't hang around and wait too long, as who knows what November might bring. I hope this gives you some food for thought and prompts you in putting some of these tips on your agendas to discuss over the coming months. We will be delighted to assist in this regard, and Steve will let you have necessary contact details at the end of the webinar. Thank you for listening, and hopefully, all being well, I will have successfully retrieved my son from Heathrow Airport. Thank you very much.